Hello, everybody, and thank you so much for joining us this afternoon. My name is Samantha Seguenza, and I am in client services here at the Retirement Group. I will be moderating this webinar this afternoon. You'll see me throw some very valuable resources into the chat. They will direct you to our calendar where you can book an appointment with an advisor, as well as how to connect with us on LinkedIn. And also a very valuable resource is our education center, where you can view all of our past recordings, topics that you may find of interest. So those will all be in the chat for you. Today's webinar, we've compiled a list of the 7 things we think you should do before leaving your company. Patrick will be coming on shortly to speak to you about strategies to increase your benefits, reduce your tax liability, and simply secure your financial future in retirement. But before I bring him on, I'd just like to remind you that although we have decades of experience here at the Retirement Group, working with both active and retired members of many Fortune 500 companies. We are not affiliated nor endorsed by any specific company. The Retirement Group is a completely independent group of financial advisors. And after Patrick's presentation, we will both be coming back on to answer questions you may have had throughout his presentation. If you have a question, please feel free to put it in the Q&A box, and Patrick will answer as many as possible before the end of this webinar. And with that, I'd like to introduce you to our speaker today, Patrick Ray. Patrick.
Thank you, Sam. Good afternoon, everyone. Thank you very much for joining our webinar today. As Sam had mentioned, my name is Patrick Ray. I am one of the senior retirement advisors here with the Retirement Group, and we certainly appreciate your attention this afternoon. Hopefully, you'll find some value in spending a little time with us today. And today I'm going to talk about 7 things that you should consider or do before you leave the company. And the good news about these 7 things, which it seems like a lot, and of course, when you get ready to prepare for one of the most important financial decisions that you'll ever have to make, it is a lot, and it's overwhelming in some cases, and that's why it's always nice to have a partner and someone you can count on to guide you through this tumultuous time, if you will, because it's not easy, and most people only retire once, and so certainly we want to make sure that we get all the I's dotted and T's crossed, and so hopefully these kind of webinars will help guide you through some of that to get you prepared. And so for those of you who are not familiar with our company, we've been around for over 30 years helping Fortune 100 company employees retire and transition into a successful next stage of their life, if you will. And so we have a ton of experience for the team members that are involved in helping folks do that. And we have offices all across the country. So I'm confident we can find someone that's close to your area that would be able to service you in the event that you're interested in looking for or gaining some help in transitioning into retirement at some point in your life. And most of us have a very intimate knowledge with respect to your savings plan and your healthcare plans and your pension plans specifically to help make sure that you're making the most important and timely decisions for all these things that are correlated to your goals and objectives. But last and probably the most important thing about what we do to help folks is help guide them through not just guessing and making certain thoughts as to what we did in the past for certain folks, but to specifically have a plan that's correlated to your goals and objectives. And so we do that through something called a cash flow analysis. And this happens to be a complimentary service that we offer in an effort to help ease into the relationship so that we can help better understand what it is that you're trying to accomplish and give you our best advice possible. And of course, that's done on a fiduciary basis, which if you're not familiar with what that term means is at the Retirement Group, we are fiduciaries. So we're always bound to do the most important and most prudent thing for you at all times. And so this helps with the transition of getting from being an employee into a retiree as stress-free as possible. And so for all of the things that Sam had mentioned with respect to the information that'll be dropped into the chat for you to get access to see previous recordings and other valuable information that we have to provide you, you might consider following us on our LinkedIn page, which is the QR code that you're looking at on the screen. You can take a picture of and get access to that, where we update specific companies and their interest rates that are correlated to their pension plans and other healthcare benefits, and just valuable information that I think would be relevant for sure for many of you on the webinar today. So with the 7 things that we consider or that you should consider doing before you leave the company, first and foremost, obviously understanding and determining how much you need to have for retirement is probably the biggest and most important thing, right? To have an idea on needing X amount of dollars to produce a certain cash flow or a certain income need that you're interested in maintaining. And is certainly unbeknownst to us with respect to what's happening in the future, but trying to visualize through written formats in projections of what your rate of return is going to be on your investments and how much you need to spend to meet your overall goals and to cover taxes and longevity. And if you're married, to make sure that your spouse is ensured a successful retirement. There's a lot of things that are involved in this calculation. And so this is the core of what the cash flow analysis would mean to you. And so, you have a lot of guidelines to consider with respect to target income needs. And of course, in order to get that target income need, you're going to need a target retirement amount. And for that target retirement amount, we're going to need to produce X as a rate of return to meet those goals and objectives. And all of these things are important. And so you also may have heard of something called the 4% rule. This is a guideline of a generic form of how much you can afford to withdraw from your retirement accounts in an effort to ensure the longevity of your assets for your lifetime. But we take that a step further and talk to folks about something called guardrails in addition to a 4% rule. So if you put these two plans in motion, it's very likely that you'll have a successful retirement, certainly based on our experience and working with folks for the last 30 plus years. But running a cash flow analysis with the 4% rule and considering guardrails is all fine and good, but it's only going to help you if you're interested in trying to meet certain goals, right? If you know you need a certain amount of money to live on, as an example, then we got to make sure that you've saved enough over your work lives to regurgitate that information or that amount of money for your lifetimes. And so that's not always very easy to do. And certainly there's a lot of intricacies involved in the planning process. And so the sooner that you get this done, the better off certainly that you'll be. And there's no timetable on how soon you should do that. If you're even in your 30s, for example, and you've got 25 or 30 years or longer for retirement to approach you, it's certainly a good idea to have a better handle on what your goals could be and how much you could afford to save and versus what that would look like as far as what you could produce in a retirement. So all of these things are important for basically determining how much it is that you need to save for retirement. Now, the next most important thing probably is determining how much you need to spend to meet your goals in retirement. And what I mean by your goals is just the realistic expenses that you could potentially engage in when you're retired, like post-retirement healthcare costs, lifestyle expenses, traveling, if it's important for you to gift to charities and to children and things of this nature. These are all things that need to be considered. And frankly, if you can only afford to do some of these things, then we've got to further prioritize which one of these things might mean the most to you. And so we start from the most important to the least important and try to check off as many of those concerns as we can address as humanly possible. But there's a lot of factors that go into this thought process. And it's not just the normal, oh, well, how long are you going to live, right? Longevity is certainly an issue. And as we continue to have better healthcare available to us and we're taking care of ourselves better and we're eating better, the longer life expectancy exists, which means it puts more stress on when it is that you retire and how much you've accumulated during your working years. Certainly inheritance becomes a more prevalent thing nowadays because many of our folks or our parents did a very good job at saving money, and more importantly, they did probably a better job at not spending it, meaning that they end up ultimately suffering an untimely death at some point with money that they can give to their family, which in most cases is important to them. And so what that means is it gives people in our shoes that are preparing for retirement an additional source of funds that we can rely on, something that we could maybe not count on, but we could assume to a fairly large degree that we're going to gain some kind of money from an inheritance because our folks are gone. And so that could be part of the planning process for some folks. We try to do our best to discount that and not even include that if it's at all possible. From a pessimistic point of view, the least your need for a portfolio return and the more you're going to spend puts a lot of stress on your overall portfolio. And if you can make that last during your lifetime, then it allows you to have a safety net or a cushion, if you will, for things that you can't control, like market volatility, or if you have a health concern for a given time in a given year, for example, or you have an expensive year because the car needed to be replaced and you had to make improvements on the home or whatever the case may be. So these are all things to help ensure an accurate retirement plan to go into the planning process. And another big factor nowadays is the housing situation, right? If you're empty nesters and all of a sudden it's just you and your spouse, and maybe you don't need that 3-bedroom or 4-bedroom home any longer, to consider what it would mean with the costs that are involved to sell your home and downsize or relocate or do something that might be more correlated to, say, living in a condo or a townhome of some sort. And what's involved in that is certainly part of this overall planning process from a retirement perspective that helps us with spending needs. And so there's no one more important than the other because all families are different, but we are trying to give you a guideline of some things to think about in the big picture and the context of understanding how it would apply to you directly. And so this is the significance, again, of running that cash flow analysis to make sure that we're on track to meet our overall goals. Many of you on the call or on the webinar today is going to have access to a pension, which is great. And even some of you are eligible to withdraw a lump sum version of your pension. So in other words, you're controlling all of those assets instead of asking the company to send you a check for the rest of your life. And so not only do we want to make sure that we're clear on the options that you have with respect to your pension and the payouts and what it means to your spouse if you do or don't do a certain thing, considering whether to take the lump sum in an environment like we're in today or the interest rates that are correlated to that and how much you may end up with if you do or don't stay on the payroll. Certainly interest rates are part of the big decision on that if you're considering taking the lump sum. And many of the plans, the folks that we talk to are all different. And so they're applicable to change at a given different window of time. Some are quarterly, some are based on a few months prior to the existing month that you actually determine when you're going to retire. Some determine in a given month, and it's good for the following whole tax year, regardless of if you retire in January or December. And so, yeah, these are all things that are obviously vital, especially if we consider that the pension plan itself or the bucket of funds that are there might be one of the biggest sources of retirement assets that you may have. And so if that's certainly true and it's relevant for a lot of the folks that we see and talk to, this would become a more crucial part of the planning process is to elect the correct pension plan decision for you and your family. And so, for example, something to consider that people don't think about is if you decide to take the annuity payment, or maybe your plan only allows you to take the annuity payment, considering something called pension maximization. This is a wonderful thought process to help plan for both not just longevity from an income perspective for your spouse, but it also helps from a tax perspective if you can do some pension maximization planning if you're going to take the annuity from the company that you work for. And if you're interested, because we don't have time to cover this particular topic today, we're delighted to talk to you further about what this technically means to you, because there's a long line of things that you need to consider if pension maximization is right for you. And if it is, it's a wonderful planning tool from both guarantees of longevity for income purposes for your surviving spouse, and also the tax side of what it might mean for them going forward after you pass away. So pension maximization is for sure something that we consider for those folks who are considering taking the annuity payment. I feel like this particular slide goes a little on the wayside with respect to the importance, because we're all considering the amount of money that you basically need to live to be comfortable. And that's the focal point for many of the folks that we see. It's like, oh, I need, $1,500 every 2 weeks or $4,000 every month, or whatever the case may be. And what is the vital back end part of how this thing whole works is the return that you're gaining on the accumulation of assets that are producing that biweekly or monthly amount that you're pulling from your investments. And so the after-tax rate of return on the portfolio might be one of the most vital things for us to consider to produce the need for income that you're going to ultimately have. And what ultimately it allows us to do is to determine the risk that's necessary in an effort to produce that. And so you might find it surprising that if I were to ask you what your level of risk tolerance is, you might tell me, well, you're conservative. You don't like to lose money. And that's a pretty standard response to the question from many of the folks that we talk to, except if I were to show you, if our conservative rate of return we agreed was, let's say 3% or 4%, and we put that in the rate of return of your investments and stretched that out over your lifetime for what you're removing during that window, you might find that a 3 or 4% rate of return is far too little for you to meet your overall goals. So unless we adjust our spending needs to reduce what you're going to take out, or we increase the risk in your portfolio to produce a long-term better rate of return that would ultimately lead to more income for you, then we're not going to be able to meet your overall goals and objectives. And this might be uncomfortable news for many of you, frankly. And so if you haven't gone through this planning process before, it's often a very, very eye-opening factor, if you will, to find out that you're not going to meet your goals because you're too conservative in your investments. And frankly, in the end, you're asking for too much money from this lifetime's worth of savings that you have to produce a longevity factor so that you don't run out of money while you're. And again, having that as a understanding before you decide to make one of the most important financial decisions that you ever have to make, we feel is crucial. And so this is the hence the reason why we're involved, and we do our best to try to guide people through this important time frame. Certainly, we want to cover our healthcare options with respect to if you're producing these options from the company that you work for, or your spouse is going to cover the two of you, or maybe you've hit 65 years old and now Medicare is your primary health insurance. So we want to make sure that we're talking through the costs, obviously. And something that I recommend if you get a chance to do this when your cash flow analysis is if you're concerned about the healthcare related costs separate from your individual need for cash flow for monthly bills and so forth, then we can run a separate line item for you and show you what the amount that you're allocating in the budget to produce to cover your healthcare needs. $1,500 a month, $1,000 a month, $1,500 a month, $2,000 a month, whatever the number is. And so this helps us so that we can consider not just the aspect of what coverage is most important for you, but talk and look through your spouse's policy and to consider COBRA if that's an option for you, and all these other healthcare options in the marketplace. And then, of course, those are all correlated if you're under 65 years old on what you have as an option potentially. But if you're over 65, then Medicare becomes your primary health insurance. And so now we've got a different set of concerns for the supplemental aspects of your planning process and what it might mean to you and what you should potentially consider. Also, for those of you who have HSA funds that could be eligible for future retirement for your health care expenses after you are gone from the payroll, this is a great thing. Many of our folks have HSA plans, which is great. If you happen to have an older plan that's an FSA-oriented plan, as you may know, you'll need to spend those funds before the termination of your leaving the payroll to avoid the loss of those funds. And so either way, it still gives us an additional pool of money. So maybe it's a time for us to consider having a procedure that you were considering getting done at some point, but we need to spend those funds. It might be a good time to be able to do that prior to you leaving the payroll, as an example. So these are all good rules of thumb and just things that are important for us to talk through with our folks to make sure we're considering all of the options for sure. Implementing a tax smart strategy is clearly a priority for almost everyone that we see or talk to. It's tough to do when the majority of the retirement assets that you are going to fall back on comes from either your pension or your 401k, because those monies have never been through the tax system before. And so what that means is that when you pull them out, you're going to be responsible to pay some tax. And so it really limits the kind of tax planning that you can do excuse me, to make sure that you're using the most tax efficient version of a retirement that you can actually gain. But for those of you, for example, who are under 59 and a half, some of the tax strategies that are relevant are being able to access these pools of money and not be subject to the 10% penalty that the IRS has. And so that would mean that you'd be using something called a 72T payment, which is structured to benefit us if you have an IRA and you happen to not be 59 and a half and you further need income from that pool of money. If you're under 59 and a half, but you're over age 55, there's another avenue of a tax smart strategy that you could consider, which is post 55 separation, which allows us to recommend leaving your 401k in the plan and pulling money on the basis that allows you to take money out based on the plan rules of what company that you work for, and allowing you to get penalty-free income from that. Now, obviously, in the 72T scenario and the post-55 scenario, you're going to pay income tax on what you take out, but at least it doesn't subject you to the 10% penalty that you otherwise would have to pay if you just pulled money out of your IRA and you're not yet 59 and a half. Some of you have company stock in your plan, which is potentially a wonderful kind of hidden gem, if you will, from a tax planning perspective, to utilize something called net unrealized appreciation, which would force you to pay some tax up front when you decide to retire, if this is applicable to you. And basically what it allows us to do is, if you have some low cost basis stock in a given company stock plan inside your 401k, and it has grown substantially over the time that you've worked there, all you have to do is pay income tax on the cost basis if you use the net unrealized appreciation strategy, and that tax is due immediately upon when you remove those stock certificates or those stock shares from your plan into an individual brokerage account. So that's a very in-depth conversation that we're delighted to have with you to see if this is something certainly that might make some sense for you to consider. And additional things like contributing monies to an IRA and converting them to a Roth, even though that might not be a deductible deposit for you, that might be something to consider for sure. And of course, some of this is correlated to your tax bracket, and if it makes sense to kind of weigh where you're pulling your funds from in retirement. Certainly in a perfect world, if you had an equal pool of money in a Roth IRA, an individual brokerage account, and an IRA, you could theoretically manipulate what you remove from each bucket of money to then correlate what you're paying the IRS. And hopefully that's as little as possible, because that's probably one of our main goals for our folks who are trying to consider a tax smart strategy of some sort. And then determining if you could potentially consider relocating to absorb some lesser taxes in given states, because there are some states that don't have state income tax, as an example. And so maybe this is a way for you to consider bundling retirement and relocating at the same time to enjoy a lesser need for concerns of what we're paying in taxes in the given state that you live in. So these are all tax strategies that we want to consider for sure. And as I've stressed a few times during our presentation today, the cash flow analysis is easily the most important thing. This is going to help us determine if, for example, the lump sum or the annuity is the best option for you, and we can run both of these things side by side so you can see in black and white if it makes sense to do one versus the other. Including your healthcare premiums. As I mentioned, there's many times where we run a separate line item to show you what the cost for healthcare is, because this is one of your bigger expenses in retirement. And certainly for those of you who are worried about retiring and covering the cost of healthcare because you're leaving at 60 or 61 and you have several years before Medicare becomes your primary health insurance, this is a great way to implement a line item to see. You're going to be able to check the box that says I'm covering my healthcare premiums, and that way you won't have there'll be one less thing you have to worry about for sure. Determining if your 401k moving into an IRA is the best option for you for consolidation purposes and fees that you're paying and that kind of thing. Or maybe the withdrawals are more important. And if you're under the age of 59 and a half and you have post 55 as an option, for example, it might be best for you to leave your 401k in the plan and pull penalty-free income from there. In most cases, that's what we advise people to do, because it's the best version of our tax-efficient retirement that we can provide and guide you on. Determining how much money you need to withdraw, given the after-tax need for investment rate of returns that you have and the penalties that you could potentially have to pay, as well as the growth of what it might mean to you over your life expectancy to ensure you don't run out of money while you're alive. This is all stuff that's going to come from the exercise of going through the cash flow analysis. And furthermore, it helps us with determining risk. It's really a great tool for us to realize that if you have a need for income at X and your rate of return is Y, if those aren't singing the same tune, for example, and those aren't moving in the same direction, it makes it very tough for you to meet your overall goals long term. And sometimes you need a visual of what that looks like over your life expectancy to understand that adjustments may absolutely need to be made. So the interesting thing is most people over the age of 50 don't have a written financial plan. And in fact, statistically, 74% of people over the age of 50 do not have a written financial plan for retirement. And this is silly, mostly because we, among many other people, offer this kind of service as a way to introduce our services and partnership to you. And if you're looking to gain help when you're transitioning into retirement and furthermore making one of the most important financial decisions that you have to make, we feel like this is a great way for you to reach out and touch base with someone like us if you hadn't already done so. So you can do that in a number of ways. Okay, you can email us at info@theretirementgroup.com. You can call our 800 number, which is 800-900-5867. You can schedule your own appointment if you'd like, and you can take a picture of the QR code on the left, and it would get you access to a calendar where you can pick a time and date that works specifically for you. And you'll have an advisor call you and arrange a time where basically based on what's best for you, you can talk with them and tell them what you're trying to accomplish and what it is that's important to you and why you're concerned about certain things. And we might be able to help, that's for sure. And then lastly, I had mentioned earlier about the LinkedIn page. If you're not already following us on LinkedIn, I encourage you to do that because it's a great tool for just general updates of things that are important to you and your given company that you work for. And so that's a wonderful tool in the event that you haven't already done that. So we encourage you to do that. And to wrap it up before I pass it back to Sam, she had mentioned at the beginning of our workshop, it's important for you to know we're not endorsed by any of the companies that you work for, and we don't work for them. We're an independent firm with fiduciary responsibility to do our very best to help you based on your goals and objectives. And so if you're looking for a partner or some help with this transition, then I suggest you reach out to us and we'd be delighted to help you. So with that, I'll pass it back to Sam and see if we have any questions. Sam? No worries.
Okay, sorry about that. Yes, Patrick, we had quite a few questions come through.
Oh, good.
The first one was, so about this 4% rule, what if the market isn't doing so hot for a while? How does that change things?
Yeah, so this is an interesting question, right? Because I think based on my experience, which this is my 24th year of being in the planning business and helping folks retire, it's a jaded question because most of us just want to assume that the initial plans that we set forth are the appropriate plans and nothing ever needs to change, right? But the 4% rule allows us to gauge a percentage of what you remove, typically around 4%, of what you've saved and worked an entire lifetime to accumulate to produce the income that you're going to ultimately need to live off of. And so when the markets are doing well, this is typically a non-issue, right? You're just moving money from your portfolio, and for a long window of time until basically COVID happened, frankly, it was fairly simple to do with very little effort. And it made people feel comfortable because there was not a need for change and there was no reason to concern themselves with what they're removing from their portfolios, et cetera. And so the 4% rule was just kind of it just fell by the wayside because the portfolio was consistently going up. But when markets aren't doing so hot, and you are still removing money because you need to live and pay the bills and have expenses to cover, then what changes is your potential need for reevaluation, if you will. And a way to look at this is if you consider how you spend your money, and if your portfolio in turn is not consistently producing what it is that you need to live off of, then you might need to consider withdrawing less. You might need to consider reevaluating what it is that you're spending your funds on. And alternatively, if you utilize this same theory, by definition, if the markets are going up and you're producing more portfolio return, you could have a more expensive year in retirement, if you will. And so this is part of our discussion when we talk about guardrails and trying to set parameters of how much in percentage format you can go above or below your withdrawal rate on what you're comfortable with. And frankly, this is the whole purpose of running a cash flow analysis, is to try to figure this out.
All righty, thank you. The second one is true. California's taxes are pretty high. Would it be worth it for me to move somewhere cheaper when I retire?
My off the record answer is yes.
I live in California and I think taxes are high.
Yeah, this is, and it's not just California, by the way. New York
right.
is right behind it, frankly. But here's the deal: if you're part of the planning process is to consider something like this, right? So if you're in a state that you're paying taxes and maybe they're a little higher than you otherwise would like, Illinois is not the greatest either. You could consider making a change. And what that would mean is to potentially relocate to a state that doesn't have income tax, for example, like Florida or Texas, as an example. Or, that is not a priority for many people. So often they don't want to look at this as a consideration. But if you take into consideration relocating because you're going to reduce the size of your home, for example, and you're trying to do that in cooperation with your planning needs because it's going to allow you to spend less money overall for upkeep and expenses and taxes and things like this, then I think it's prudent to consider maybe you want to move states because California taxes, as an example, are really high. And so this is clearly a personal decision. There's no way we would tell you that that's absolutely something you have to do. But I think it would be certainly remiss of us to not talk to you about what a tax efficient version of your retirement looks like. And that may actually include relocating to a state that has cheaper taxes.
All righty, thank you. The third question, how should I plan for an inheritance? Should I include it in my regular retirement planning or think about it differently?
Yeah, this is a good question, and I mentioned this a little earlier. Look, we have we're in a generation as we continue to move forward where our parents did a way better job at saving money than our grandparents did. And so what that means is it's just fairly likely, unless something went horribly wrong from either a expenditure perspective or a health perspective, that your family is going to end up potentially leaving you money. And I am a pessimist by nature because basically that's what we get paid to do for a living, is to watch out for people's life savings and make sure that people don't run out of it while they're alive. And so if I'm answering this question for most folks and they ask me, should I plan for an inheritance and should I incorporate that into my planning process? I would say absolutely not. Because if you think about the found money concept, if we know that your retirement can function off of what it is that you worked and accumulated during your lifetime to have and to meet your goals and objectives, then it can't possibly get worse if you inherit more money, right? So in my eyes, most of our planning tools are set up to make sure that what it is that you're doing meets your goals and objectives. And unfortunately, we have some folks, and I've ran into a few of them, that want to consider their inheritance as a function for them to spend more of their own money because they're fairly certain that they can get an inheritance at some point in their life that would replace what they're otherwise removing. So in other words, they're thinking about spending more in retirement than they otherwise could afford to spend because it's very likely in their case, or in some cases, that they're going to get an inheritance. And I would discourage you from thinking in those terms, just because I like to think that if you don't ever get those funds, then there's nothing to be disappointed about, right? There's nothing that's going to interrupt your plans or to throw a curveball at you that says you're going to need to make an adjustment because you otherwise didn't get your inheritance. Because let's make an example of your parents getting the probability of needing to be cared for, and all of a sudden they're in a home of some sort and they spend several $100,000 or more of their own funds to care for themselves before they die and ultimately give you the money. If you had went with thought that you were going to replace what you spend out of your retirement assets because you're going to ultimately end up getting money, you're getting less money now because of that scenario. And that's a real life scenario that could very well come up. So I would encourage you to think differently about incorporating your inheritance and basically setting that aside for future needs.
Alrighty. Number 4, if I decide to sell my house and move somewhere smaller, how should I think about that in my retirement planning?
Yeah, that's a great question. I mean, if you're planning on downsizing, the selling your home and supplementing your retirement savings is certainly something you could consider. I mean, we saw a lot of that in the most recent few years because of what the value of houses had increased to. But a lot of that was also in a time where we had very favorable interest rates. And so, for those of you who have a 3 or a 3.5% mortgage because you refinanced, 4 or 5 years ago or something, you might be surprised at what it would cost you to refinance that debt today, because you're not going to get 3.5% on a 30-year mortgage today because of what interest rates have done recently. So incorporating things like selling your home and the costs for, having an agent help you and the relocation factor and the taxes that are associated with that. And again, then maybe you could incorporate, if you went to a state that you weren't paying state tax on, for example, maybe that saves you 6 or 8% or something, and then you could make the numbers work. That might make some sense. And so, of course, it also depends on the housing market, right? As to some housing markets are more attractive than others. And so it might help you sell your house if you're in an attractive environment. But then, of course, if you decide to go to a further attractive location for, housing in a different state, for example, you're going to pay a premium probably at a higher interest rate also. So those are all things to obviously consider when you're either selling and or buying a home and relocating and those kind of things, because there's moving costs and potential things that, like, for example, how much do you have to spend to get your current home up to speed to sell it? Renovation costs are an issue potentially. And like I said, realtor fees, these are all just things that would make some sense if you're going to consider selling your house and either downsizing or moving somewhere else.
All right. Last two kind of go together. The first of the last two is, how do I go about setting up these guardrails for my retirement portfolio?
Yeah, so this is a good question, and this is probably a very long answer. I'm going to do my best to keep it as short as possible, but this is a pretty intricate discussion that should be had with someone who's concerned about this, because again, what we're looking at is your expenses, right? And if we know that you're going to use a 4% rule as a factor to just start off, and you have X amount of dollars and it produces, a certain amount of money per month to live on, then setting a guardrail would allow us, for example, to have a percent. Typically, guardrails are set in percentage format. So if you set one that's set, let's say 20% on the high and low side. So as I mentioned earlier, if your portfolio goes up, it allows you to increase your withdrawal rate to account for your portfolio totals going up because the stock market went up if you have exposure to equities. And conversely, if things aren't going as well, then you would consider and implement a strategy that would allow you to spend less. And it's really tough to do that. Okay. That's just a fact. It's just my experience that when we have to talk about reducing someone's expenses because they're spending too much money, or they're increasing the probability of running out of cash while they're alive, or that combination of those things, plus the portfolio, for example, is not doing as well as we'd hoped it was because, the recession is here, or interest rates are going up, or all of these things. It's like, you to have to tell someone that they get to spend less money when they ultimately retire is a very difficult thing to do. And so if you go into your retirement with the planning process of, you get to spend a direct amount that's correlated to what we're talking about, then you already have the expectation that when things aren't going as well, you're just going to be able to spend a little bit less that next year. And so it just gives you a ability to adjust accordingly, which helps us understand that if you're making money, then it makes some sense to spend a little bit more in that given next year, for example. But if you're not making as much money, it certainly doesn't make any sense to spend more money, because then you're removing more money from a value for potential purposes that's down in value. And it only creates a snowball effect that is very difficult to, if almost impossible to ever get out of during your lifetime. So, each tax year, you can adjust for this accordingly. And so if you compare what your current portfolio is doing and see how that basically coincides with the guardrails that you're comfortable setting up for, up and down what the withdrawal rate that you need to meet your overall goals and expenses are, it will help you have a lesser volatile retirement. That's for sure.
Alrighty. Now that you've answered that one, this one does seem even more similar, but I'm going to read it anyway. Okay. This is the last one, Patrick. Could you break down this guardrails idea for me, and how does it actually work? Which you kind of already answered this, but.
Yeah, so just to reiterate, look, what we're doing is we're saying in simplistic terms, if you make more money in retirement because your portfolio value went up because the stock market did well, the following year we get to spend more money. Okay. And if the converse happens, where maybe we didn't meet our retirement projections for return perspective, from a return perspective, then basically it allows us to reevaluate your expenses and spend a little less money. And so, for the same reason that allocation helps you avoid the particular peaks and valleys in a given portfolio from a return perspective, this is kind of similar. All we're simply saying is that we can put some parameters in place. And look, from experience, retirement is some of retirement is a mental aspect, and being able to follow through with what needs to happen to meet your goals, right? And so that means that you have to be cognizant of, if things are performing poorly. Many people think that the adjustment technically is to go into the portfolio and make trades to adjust accordingly, right? And maybe that needs to happen to some level. But what's probably more important is to adjust your spending so that you don't need as much money, and therefore can help cushion the blow of a return that's not performing as well as we otherwise would like. So hopefully that helps you gauge just setting some upper and lower limits to what you can afford to spend, which is kind of dictated by the return that you're getting. And you can increase that when the value significantly outperforms and grows, and you can adjust it downward if we don't do as well as we otherwise.
Thank you, Patrick. That was it. That was all the questions for today.
Oh, good. Okay. Yeah, wonderful. Well, certainly we appreciate your time today. Those were great questions, by the way, and hopefully you found some value in not only the responses and the questions themselves, but the presentation and the material that we covered. And so we encourage you to reach out to us if you're looking for a partner to go through this important journey in your life with respect to retirement, because like I mentioned earlier, most people only do it once. So we want to make sure it's right. And so we're delighted to help you. Again, you can reach out to us at 800-900-5867. You can also email us at info@theretirementgroup.com, and we'll be delighted to help you. Okay. Thanks for joining us today, and we'll see you next time. All right.
Thank you.